Hello, my name is David Quo, and with me today is Maynard Payton, editor here at the Motley. Hello, Maynard.
Hello, David.
Right, we are going to bring into the studio today an argument that we've been having off-air for your benefit. Now, the argument is, should you invest in big caps or small caps? I like the big, Maynard likes the tiny ones. So, why do you like small caps, Maynard?
I like small caps, David, because they offer much more potential for large capital gains than larger companies, David. Small companies tend to fly under the city's radar. Their progress tends to be overlooked by the analysts too busy focusing on blue chip companies, and you're much more likely to find a cheap hidden gem bargain.
But they're more risky, Maynard, because, in the case of the big caps, the chances of a big cap losing 50% of its value and then being decimated is probably non-existent. But on the other hand, with the small caps, if they were to lose 20, 30% of their market value, you could actually find that they won't be able to survive.
Just ask bank shareholders how safe Footsie 100 companies are. Think about banks a few years ago, nice and safe. Were they paying dividends? Shareholder returns have been decimated, billions of pounds lost. Footsie 100 companies, they're not all safe. Just think about Tesco this year, 20% down from a profit warning. Tesco, a long-term buy and hold share, textbook long-term buy and hold share. Disappointed investors.
But let me ask you this, Maynard. Are they still around? Yes, they are. Lloyd's still around. RBS still around. Barclays still around. And let me think. Tesco's. Yes, I was shopping in Tesco's the other day, Maynard. So therefore, these companies still exist today.
They still exist, but it's all about risk and reward. If you are prepared to spend a bit of time looking at companies in depth, I think you could find much better bargains down the stock market in smaller companies.
But don't investors want to be able to buy a share, go to bed tonight, and know that the company is still going to be around tomorrow? Look at some of these companies. BAT, for instance, British American Tobacco, it's been around since 1902, Maynard. It's been around longer than you've been on this planet. And it's going to be around for the next 100 years, possibly.
That's true, but it's yesterday's success stories. Footsie 100 is just a collection, really, of yesterday's success stories. You've got to be looking for tomorrow's gains or going to come into the future.
Hang on, BAT has delivered an annual return of 17% a year every year for the last 10 years. That is hardly yesterday's story.
You're looking backwards. Investors have got to look forwards. And
17%, Maynard. I take 17% any day.
David,
I do.
You're looking backwards, David. Investors have got to look forwards for growth, and smaller companies generally offer much, much greater prospects for growth.
Okay, give me one company that you like, Maynard. I've already told you the one I like.
But one company I like, Tasty. Now, this is
Who?
Tasty.
What do they do?
It's a restaurant chain. They've got 20 restaurants. Mostly sell pizzas. Now, the story here is about the management. The management have a track record of building restaurant chains from nothing and selling them or developing into 100 million, 200 million pound companies. Tasty at the moment has a market cap of 30 million. So if it can do the hat trick and turn it into another 100 million, 200 million pounds, you could have, 3 times, 6 times your money?
If I'm going to invest in a restaurant chain, Maynard, I would invest in McDonald's. I know that if I buy shares in McDonald's, I wake up tomorrow morning, McDonald's is still going to be there.
That's true, but it's not if you want a nice, steady return with a little bit of a dividend.
That's what investors want.
If you want potential for large capital gains, small cap companies is where it's going to be. You're not going to make 5, 10 times your money at McDonald's.
Tasty is not for me, Maynard. I don't like the taste. So anyway, give me another company.
I'm not a fan of McDonald's either.
Okay, so give me another company, Maynard.
French Connection.
Yeah? Are you wearing one now?
I'm not wearing French Connection.
Exactly.
Well, here's the story. This is all about investment, risk and reward. French Connection.
What, buy shares in a company that nobody wants to buy its products?
They may want to buy it in the future. French Connection, FC UK brand, went stale years ago. Share price has collapsed from £5 down to 25p. Market cap now is about 25 million pounds, but the company's still selling clothes worth 200 million pounds a year. If it can make a margin from that 200 million pounds, if it's currently making a loss, but if it can make a margin from those 200 million pounds of sales, the 25 million market cap will look extremely cheap.
Why would I invest in French Connection when I can invest in Unilever? Unilever, over the last 10 years, has delivered for me as an investor 9% every year for 10 years, right? Why would I want French Connection, the risk of French Connection, when I can have the steadiness of Unilever?
Because there's a much chance of a greater capital gain from French Connection. Just last year, the company, there was just signs of a turnaround in the company. The shares quadrupled in less than 12 months, went from 30p to 130 pence. I think if French Connection can sustain a turnaround, you could at least quadruple your money from here.
But
you
I
can't do that on Unilever.
But I want a company that I know has a legacy. I want to be able to hand my Unilever shares to my son and say, here you go, son, here are the Unilever shares. I've held them for the last 30 years. You can hold them for the next 30 yourself.
I'm not interested in handing over my shares to my son. I'm interested in capital gains in the next few years. That's fine. If you want to collect your dividends, that's fine. I'm looking for large capital gains, not dull, plodding shares in the Footsie 100.
I tell you what, we'll compromise. I think, when people are building a portfolio, they need to pack it full. Think of it like a cake. You want to make a good cake, that's full of good dividend yielding shares. And then if you want to put a cherry on the top, by all means, put taste.
Yeah, I think you should have perhaps a part of your portfolio in large cap shares, producing a nice dividend stream. The other side, a bit more exciting in small caps with the potential to make large capital gains.
Okay, we'll agree to disagree, Maynard.
Okay, David.
Thank you for watching. My guest has been Maynard Payton, and I have been David Quoll.